This is in honor of the Super Bowl, which the Chiefs won over the weekend. An exciting game overall. I didn't love the end, not because of the call. I mean, these things that happened. I'm sure if you're in Philadelphia, you're not happy about that call. But I just don't like running out a game and kind of killing the suspense. I know that's the way the NFL is, but you run out a game with 2 minutes left,
but you don't have to like it though, right?
I don't have to like it. I would like to see not be able to run out the game that fast with the 4 downs and just have the chance for Philadelphia, the Eagles, to have a comeback. That would be great. Maybe give them at least a minute. I mean, time is what it is, but I just don't like being able to run out without nothing really happening on the field. But, it is strategy. And I get it. Yeah. So you want to talk about that? Some people make these predictions going forward based on the big game, who wins the AFC winning or the NFC, right? There's some big, long-standing projections there. You're going to go through that because this is really key to where the markets go going forward, right, Brennan? Thank you.
Yes, sure, key. But yeah, the game was good. Just dovetailing on what you said, and as well, Rihanna was the halftime show, so it kind of goes in relation to my month and day of love. So just bringing it full circle there. anyways, so yes,
no one knows
in Super Bowl fashion, I thought that I would bring up this post from Yahoo Finance's Instagram, which states, investors should hope the Philadelphia Eagles crush the Kansas City Chiefs if they want to see stocks go up, as historically the S&P 500 has outsized gains when an NFC team wins, and returns are even higher when the game is a blowout regardless of which team wins. So considering the Kansas City Chiefs, an AFC team, won the Super Bowl on Sunday by only a narrow margin of 1 field goal, does it mean we should expect the market to perform poorly? Of course not. However, it reminded me of the Peter Lynch book that I am slowly but surely reading, when he says that in hindsight, studying history and philosophy was much better preparation for the stock market than, say, studying statistics. Investing in stocks is an art, not a science, and people who've been trained to rigidly quantify everything have a big disadvantage. And he goes on, he uses an example of how centuries past, when people heard a rooster crow, they decided that it was the crowing that caused the sun to rise. And Peter goes on to reference this to Wall Street, saying that experts confuse cause and effect in offering some reason why the stock market goes up. And his writing from 1989 relates directly to this post, as he uses a certain conference winning the Super Bowl as one of the various nonsense indicators. Now, it may be fun to contemplate that a football game can somehow predict stock market returns, but to the intelligent investor, an article and indicator like this is just noise. The key is to focus on what you know, buying an array of quality businesses. So yeah, I just thought that I'd bring it up on the podcast. It was kind of funny when I saw it, and it was kind of funny reading that book and seeing Peter Lynch bring it up, this exact thing that I saw on Instagram the other day, and mocking it essentially.
Mm-hmm. So the market's going to perform poorly now, is what you're saying.
That's clearly
not what I'm saying.
That's a lock. Take it to the bank.
I've heard about this example a couple times before too, and it's basically what you're doing is you're comparing a bunch of data and you're trying to find a correlation. Like if one thing happens, does another thing happen as well? So certain team wins the Super Bowl, does that cause something else to happen? And the thing is that there's a lot of correlations out there that are not necessarily related to each other, right? Like a lot of times they will happen just based on pure, happenstance, just luck. If you think of all the possible relationships that exist between things happening in the world, of course, you're going to find examples where there's a high correlation between two things happening that are just completely unrelated. So that's called false correlation. And in statistics, it said that most correlations that you find are false, right? So that's why things like torturing a data set, like just, doing whatever you can to the data set, transforming the data, checking every correlation just to find something is like a really bad way to go about research. Like there should be some theoretical connection between
Yeah.
two things happening. And also, just because things are correlated doesn't mean that one causes the other. They could be caused by something else, or it could just be, pure luck. But I mean, yeah, I'm not sure where we would find the theoretical link between these two things, except you could say that if this information is well known, it could be a self-fulfilling prophecy, so it could actually change people's behavior. But I would think that would happen quickly after that information became available. Whereas what this is saying, it's the annual return that it's predicting. Is that correct, Brendan?
Yes, correct. The annual return.
Yeah.
And just referencing back to Peter Lynch, he goes on to say some of these nonsense indicators, such as like hemlines for pants, increasing, causing the stock market to go up.
Yeah, like there's been like
break.
research reports put together to prove this point, where it's like eating chocolate will make you more likely to be a serial killer. Like, it's easy to find if you're looking for them fake correlation.
Uh-oh.
But say again, so what is it that causes, like, what team?
Yeah,
winning?
so it's a team from the N or the.
Well, I mean, this one is about as ridiculous as it gets.
Yeah.
NFC versus AFC. Like, I mean, come on. Like, there'd be absolutely no. I mean, like Aaron said, there needs to be some kind of relationship between the data points.
It's a division.
One league
basically.
versus
Okay,
another league.
One league versus the other, and when the one league wins, the market does well that year.
Yes, and
So
then
statistically, does that league usually win, or is it usually closer to 50-50?
This I don't know. I don't know.
Ryan,
I'm not a huge
Brennan, do
football-
some research for God's sake before you.
Because I mean, that'd be something to look at. Because
This is the main issue.
In
that
most
we
years,
gotta
the
get
stock
down
market
to.
goes up. So if in most years that other league
Yeah.
also wins, then you're probably going to see a relationship there, even though one has nothing to do with the other. They're just.
It's crazy that we actually require a relationship between the data points to actually have any type of impact at all. But anyway, yeah, I mean, in this case, like there's not any relationship here. It's a fun little data point that Brandon brought up that he thinks is actually a lock. But
yeah, I'm sure.
Well, Brennan,
he's simple, right? So that's okay. No, it's good. There's many of these, and it relates to the book you're reading right now. Clearly, very slowly because
how's that book going?
For 2 years.
When are we going to get it? When are we going to get the summary?
Well,
a couple years
3
from
years
now.
from now.
Couple years from now, we'll see.
Brandon's hiding all the information.
Yeah,
for himself.
I'm about like maybe 75 pages through, so
It's a picture book too. That's the problem.
There are some pictures of stock charts,
A lot of pictures.
and graphs and tables. So it's
His favorite.
It's quite the fun read.
Yeah.